Hi all. So today we are going to discuss what are some of the options to save taxes in US beyond 401k. So a lot of people they wonder, hey, I'm spending some of my money in 401k to save taxes, but what else can I do? Now, first, let's discuss a little bit about 401k. Um, so 401k, when you're investing, keep in mind that, your money is kind of logged till you reach 59 and a half or almost 60 years of age. And if you take money before that, you will end up paying penalties. So it's a good way to invest money and save on taxes, but you should keep in mind this thing. And secondly, when you will take money out of 401k, at that point, you will be paying taxes. So for example, if you have $1 million invested in 401k and you're kind of, taking all of it out and your tax rate is say 30%, you will end up paying 300k in taxes. So that is also you should keep in mind. Another thing is many companies, they provide matching, uh, employer match. So that's a good way, and that's why many people invest in 401k. So it's good to invest in 401k till a match because it's kind of going to compensate for the taxes which you may end up paying later. But anything beyond that doesn't make sense because of the reasons we discussed earlier in this video. But some people they have a lot of money, they may max out 401k, still, they have more money which they want to invest and save on taxes. So what can they do? Before we go ahead, just want to make sure that you stay till the end because we are going to discuss multiple techniques. And if you're liking this video, then please go ahead and like and subscribe this channel. We are going to discuss a lot on these topics in future videos. Now let's understand, try to understand one concept. So what many wealthy people, they do is to save taxes is, so if they have an asset, then instead of selling that asset, they take a loan out of that asset. As long as they're able to, generate more return compared to the interest which they are going to pay on that loan, they are good. Because when you're taking loan, I mean, you are not going to pay any taxes. You will pay tax when you sell your assets, and that's how the taxes gets kicked in. So if you keep this concept in mind, you may end up finding more opportunities around you. So one thing which many people do is real estate. So what they do is they'll buy a house. So for example, they're buying a rental property for say 300k. Now the tenant is paying for the mortgage, interest rate, and they may be earning some amount of cash flow. But over a period of time, that property may appreciate from 300k, so say 450k, 500k, something like that. Now at that point of time, instead of selling that property and having a event where they may end up paying tax, what many people do is they will either refinance the loan and cash out that extra 200k tax free, or they may open a HELOC, a home loan line of credit or things like that they will do. Or if they are buying a different property, they might do a 1031 exchange. So again, one way is this, real estate. It's an asset which is kind of going to grow at a higher pace, or the interests are kind of paid by your tenant or something like that. So you're able to compensate, and this is one way you can save taxes. Now, real estate, it may not be kind of suitable for everyone. People may not want to maintain a rental property, deal with tenants, and all those things. So what about them? What can they do? Another option is, which many folks do, is they buy a permanent life insurance, and they keep their money in that policy. So basically, permanent life insurance is an insurance which lasts throughout your life, and it has a cash value component associated with it. Permanent life insurance, you have a cash value component. And there are many different kind of permanent life insurance, but one kind which is pretty advantageous is index universal life, and that's what we are going to discuss a little bit more. But many people, like, they'll say, hey, I heard that, you should only buy term insurance. Why not? Because see, term insurance is a very good product, and definitely based on amount of money you have to invest and, your life situation, it may suit you well. But imagine, like, someone who's say 30-year-old, like, you see a lot of term life insurance ads on internet where, a young lady is kind of, saying that, hey, I got such a cheap term life insurance for $1 million. But in this case, situation, what's happening is, yes, if you are say 30, 25-year-old, you will get very cheap, because even if you buy a 30-year policy, it'll kind of lapse at 60 years. And someone, especially a female passing at 60, the probability is way lesser. So, I mean, definitely life insurance companies are going to give it to you at a very cheap rate. But does it satisfy your needs? First, like, after it expires, you can do nothing about it. There's no cash component associated with it. So how permanent life insurance can help you, and specifically if you look index universal life. So what is index universal life? So in index universal life, what happens is you pay a small amount of premium, or whatever premium you decide every month. Some amount of it is used to fund your cost of insurance for death benefit. So it has a death benefit component, and rest of the amount goes to cash value. And an index universal life, also known as IUL, it is aligned with a particular index, and your cash value will grow based on the growth of that index. So for example, let's look at S&P 500. But one thing which is different here, and I mean, no other product provides, is that it has a floor and it has a ceiling also. So by floor, what it means is, so for example, your IUL policy, if it has 0% floor, it means that you will not get a kind of, negative return. So if tomorrow S&P 500 fell down by say 30%, 50%, you're not losing that 30, 50%. You're staying at the same level, kind of, 0%. But if it goes up by say 6%, you get that 6% gain. And that is a big benefit. Just think about it for a second, that your money is safe. It is not, there's no possibility of it going down. So tomorrow, if you're retiring, say at 60 years, you have $1 million in a particular account, and index or market crashes by 50%. Then if it's a regular brokerage account or 401k, your $1 million will become, $500,000. And if you start withdrawing that money, you will be incurring a lot of losses. But here, if it is $1 million, it stays at that level. So that's a big advantage, having a floor. So it reduces a lot of risk. Now, one kind of other thing which may be a little bit disadvantage is that there is a ceiling. So for example, if there's an 8% ceiling, then if market is growing by 8%, you'll get 8% return. But if market is growing by say 10%, 12%, still you get 8% return, because that is the ceiling. So it is a trade-off which you are having, but still, like, you are getting a return which is kind of having a low risk comparatively. Now, let me show you some of the stats here. So if a 30-year-old start putting $500 per month in an IUL policy, and we are assuming that the rate of interest or growth is 5.97% on an average over this period of time, then they will end up getting almost $1.1 million in a death benefit. And out of this $1.1 million, 904K will be a cash value which they can take out anytime they want. And so this 914K, if planned properly, you can take out tax free. So that's where, the concept which I talked about works, that, you take out this money as a loan out of your policy. And what's happening is insurance company is giving you this loan, having your cash value as a collateral. So you may end up paying insurance company a certain percentage for this loan, but this cash value is also generating a return. So kind of interest rate which you're paying and this cash value are canceling out each other, and you're paying, say, small amount of interest rate. And again, you don't have to pay this loan back, because what's going to happen is, after some, this is a permanent liability, it lasts forever. And whenever you pass away, that time insurance company can deduct this outstanding loan from your death benefit and pay rest of the amount to your beneficiary. So for example, out of this 1.1 million, you take 300K out for whatever reason, or 500K, and you don't end up paying, and some amount of interest is accumulating. Finally, your beneficiary will get that 1.1 million minus 500K. So 600K they'll get. So this is a policy which you can use while you're living, and when you pass away, your beneficiaries are getting it, tax free. That benefits are disbursed tax free. So that's a big solid benefit which this kind of policy provides you. And it's not that at the end of this term only you can take out. So generally, at every year there will be a cash component of this policy. So for example, for this example, at 20 years, so person will have 470K in death benefit and almost 238K in cash value. So if you need money for some reason, you can take out of this policy as a loan. So this is a big benefit which IUL provides, and that's why you see many people investing. And another good part is that there's no limit how much money you can put in an IUL or Indexed Universal Life, as long as it's structured properly. And there's something called MAC. It is not crossing the threshold, you are good. So unlike 401k, where you can invest only say 20K amount, or Roth IRA where you can invest 6K, here you can invest as much as you want and take out this money at any point of time, and it is giving you a return which is having a relatively low amount of risk. So these are some of the ways you can save on taxes. One thing which you should keep in mind is that this IUL policy, or Indexed Universal Life policy, can be structured in multiple ways. So in certain ways you may end up paying more in fees and all, and get less cash value. And in other ways, you get more cash values, and fees and all are comparatively lesser. And how it's structured matters a lot. And that's why sometimes it gets a bad name also, because some of the agents, what they do is they structure in such a way that they end up getting more commission. So that's why you should make sure you're working with someone who's having your best interest in mind, so that they structure in such a way that you get maximum cash value out of this. So so generally, when you look at this policy, right, and I'll try to show you also one. It should be such a way that whatever money you're investing in this policy, it is equal to, it kind of is equal to the cash value in first 8 to 10 years. So let's look at this kind of a sample illustration. So here this person is paying $500 per month, as we discussed, so almost $6,000 per annum. And if you look, here's the cash value which is being generated at 5.97% rate. So he's paying $6,000 and almost $5,600 is the cash value. So if this person want at the end of year, he can take out this amount as a loan, and still he'll have this much, death benefit. Now if you'll see here at the end of 10 year, this person would have paid 60,000 in premium, but look, the cash value is more than 75,000. So he can take out 60,000 out of this policy. So basically this policy is for free, and still he has 15K cash value left here and a death value. But obviously he'll have to continue paying premium later on. So your premium should not be, your cash value should be able to fund the premium. And if it doesn't happen, then you might be in trouble. But here if you see, so this is how a good IUL policy should look like. It should be able to recover whatever premium you paid in terms of cash value under 10 year. Here it is happening at somewhere around 8-9 years. And it should be having maximum cash value in the initial years. Sometimes folks may create IUL policy in such a way that you have these $0 here in cash value. Maybe death benefit is more, but here what happens is you end up paying high taxes, fees, and commission to that insurance agent. So now if you see at 20-year mark, this person has 238K in cash value and almost $500,000 in death benefit. If he needs this for whatever reason, buying a car or pay for kids' education or whatever, they can take money out of this tax-free. And same thing continues. Now, if this person want to retire at, whatever amount, they can look at this cash value, and if they have enough, they are good. So that's how so I hope you're able to get some idea, how you can save taxes beyond 401k. And if you have any questions, please feel free to leave comments. And if you are looking to get your planning done and getting a IUL policy, then I'll leave some comments below, so you can reach out to coverclan.com. They can compare with say 50 or more products and companies and get you the best possible rates and coverage. Feel free to reach out to coverclan.com to get your IUL policy. Thanks and have a nice day. Bye-bye.